Canadian banks, oil, and gold. Banks, oil, and gold have made up the majority of the TSX for a long time now. If you take a look at those three sectors, you're probably looking at 70 to 75% of the index are just those three sectors alone. And so, very easy to explain. If the TSX is down on a certain day, it's probably because two of those three sectors are negative. If the TSX is higher, it's either because all of them are higher, or maybe two out of the three are higher. And so I thought we'd take a look at these three sectors in particular to see how the TSX is doing. And we already know, as I mentioned to you in the last segment, TSX is up about 4.5% year to date. Well, whereas a lot of that are those gains, where have those gains come from? And we know a lot of those gains have come in the last, I guess, month and a half or so. So let's take a look at a bank chart, Canadian bank stocks, and you could see that bank stocks have been on a bit of a run. We know banks in their most recent quarterly report, they didn't really report the best quarter. They also didn't report the best outlook going forward. Canadian banks are going to do as well as the economy in most times. If the economy is slowing down, if banks or if individuals are unfortunately defaulting on their debts, businesses, more defaults out there, banks are going to feel it, right? They're setting aside more money for credit losses, for potential bad debts. We're not seeing as many people borrow to buy a house, borrow to expand their business, because interest rates are just too high in this country right now, over 7% prime rate, as we said earlier. So banks have struggled. However, there's always a however. We know that stock market looks 6 to 12 months at the very least in advance. And if we believe that the Bank of Canada has stopped their interest rate hiking policy, that they're not going to raise rates anymore, and that the Federal Reserve will also not raise rates anymore, then a lot of bank stocks, I think, should fare quite well. And so what investors do is they start buying up the banks because they're paying such great dividends, but also because they could represent really good value in the future and could do well 6, 12 months into the future. And so that's why you're seeing bank stocks start to rally as of late. But again, bank stocks are just coming off low points, many of them trading single-digit PE multiples, which is low for them. And overall, banks are coming from a spot right now just off their lows. Moving forward to oil stocks now, or oil in general, the oil sector. And we can show the chart of oil. And you can see oil has really fallen off in the fall and as we've headed towards year end. Oil, actually, here we have it at 71.82, but I can tell you, price of oil, WTI, is actually below $70 right now. So whereas banks have seemed to bounce off the lows that we saw in the fall and month of October and has now started to move higher, we haven't seen that the price of oil as yet. And so, yes, oil stocks have not fared nearly as well as many people had hoped coming into 2023, and as many people have hoped that they would fare towards the end of this year. And I think a lot of that has to do with, the OPEC wanting more production cuts. Some of the OPEC nations didn't agree with that, so they weren't able to increase the cuts. The production cuts that they have in place right now, the Saudis, the Russians, they remain in place, and they'll remain in place at least for the foreseeable future. But the United States is picking up the slack, plain and simple. Whatever production cuts we're seeing out of some of the other OPEC, some of the OPEC nations, the United States is producing the most oil out of any country right now, over 13 million barrels a day, whereas the Saudis now are down to under 10 million barrels a day. So when you think of oil production powerhouse countries producing oil, you got to look at the United States now. They're producing more oil than anybody else. And I think that is a big reason why we're seeing oil at the low points as we head into 2024. Lastly, the third sector, you can show a chart on this one. We have gold. Now, gold is total opposite of oil. Gold is at all-time highs, or just recently reached all-time highs, well above 2,000 an ounce. Why is that? Well, usually when gold moves higher, we find that the US dollar is struggling. And as many people believe, if the Federal Reserve is done raising rates, we've seen the the US dollar pull back because of that. Higher interest rates usually means that people are putting more money into US treasuries and the US dollar moves higher with it. Well, as we move into 2024, we all believe, and we'll see later on this afternoon if the Fed holds pat, but we believe Federal Reserve will not be raising rates any longer. And in fact, at some point, will cut rates in 2024. There are many people believe that we could see a mild recession in the US in 2024. So this is all affecting the US dollar and causing some uncertainty. There's uncertainty in the Middle East right now, uncertainty still, Ukraine-Russian battle, war in the Ukraine. And so a lot of that has helped the price of gold because as we know, price of gold moves higher when there's uncertainty in the world and people are fearful. So when I look at buying any of these three ideas, gold, oil, banking today, you probably know what I'm going to say. It's banking. I believe that I'd be a buyer of the Canadian banks, maybe not a buyer of gold at these highs. Perhaps maybe want to, for a diversified portfolio, perhaps own some good dividend paying oil stocks just for a small portion of a portfolio. But I'm a big believer in our Canadian banks. I'm a big believer in the US banks. And I think if you put your money there, I think over the next 6 to 12 months, that sector will fare very well.